What's up? Coach B here with another episode of Chalk Talks. This is a series of videos I've been and will continue to do explaining market terminology, trading techniques, option strategies, and really anything you want to hear about. So please, if you have any questions or suggestions, leave a comment below in one of the videos. And I'll always, if you're enjoying the content, hit the like and subscribe button. All right, so on the last video, we covered some terminology used when categorizing contracts: at the money, out of the money, in the money, along with the difference between intrinsic and extrinsic value. That's that time value. Remember, only in the money options hold intrinsic value. And really, that value is the difference between the stock price and the strike price. Okay, so intrinsic or time value has a lot of factors that play into it, including the Greeks. But before we get into the Greeks, today we're going to talk about volatility. If you've been looking into options, you may have heard or read about historical volatility, HV percentile, and implied volatility. So volatility in general basically is an indicator of the range of movement, okay, whether that be up or down. To put it simply, historical volatility is taking the average price of a stock over the past year and then giving you an indication of how much movement happened both up and down in the stock over that year. So as an example, let's say a stock's currently trading at $100. It started the year at 100, went down to 50, went up as high as 150, and now it's back at 100. So the price started at 100, ended at 100. The historical volatility on that stock would be somewhere around 50%. Okay, the average on the year is 100. Started at 100, ended at 100. Also, it's the current trade price, and it moved 50% in either direction. It went down to 50. That's a 50% drop. Then when it was trading right back at that 100 level, it went up to 150. That's a 50% gain, and back down. That's kind of how you get that historical volatility number. Another example, let's say a stock again is trading at 100, started the year at 60, went up to 120. Now it's at 100. Okay, so from 60 to 120 to 100. So the average price there would be 90, the difference between 60 and 120. The historical volatility would likely on that be somewhere around 33% range. I think the math's right. I hope that checks out. And basically that's telling you over the course of the year, the price has fluctuated 33% from its average. So again, the average is 90. The stock traded as low as 60, like a 33% drop. It traded as high as 120, 33% gain. And even though right now it's at 100, we're basing it off that average and that fluctuation. So that's what historical volatility is. Honestly, I don't pay too much attention to historical volatility when buying option contracts because you can see that same information when looking at a bar chart. But it can be a useful indicator to get an idea of the historical movement in a stock over the course of a year. And I thought we should understand what it is to not get it confused with what we're going to talk about next, which is implied volatility, which is something that you absolutely need to be paying attention to when you're looking at stock option prices for a couple reasons. The first is it greatly affects the price of your contract. The second reason, because it's an indication of where the market thinks a stock is going to go. There's so much that goes into implied volatility. But I'm going to try to simplify this as much as possible. IV, implied volatility, is based on the amount of open interest in a particular options chain. So basically, or option strike. So how many call contracts, how many put contracts are being bought and are sitting there in the chain right now? That's what the open interest. So for example, we have a stock that's trading at $10. If there's 10,000 call contracts open, the IV might be low and the premium on the $11 strike might be going for 30 cents. Now, if tomorrow rolls around and all of a sudden there's 100,000 open contracts, meaning that 90,000 more got bought today, the IV is going to increase, right? The implied volatility, because now there's more open interest. And that $11 strike might end up costing you $2 instead of 30 cents. Even though the stock didn't move at all, stock's still trading at 10. So again, same stock trading for $10, and the premium on the options contract can fluctuate drastically where you're paying more or less to buy it, all based on the IV, right? So what the implied volatility is. So why does it do that? Because part of how option contracts are priced is based on the likelihood of a contract becoming in the money. So if the market is buying up a ton of call contracts, then the market thinks the stock is going to move. So because the market thinks that, the IV is going to go up and your contracts are going to be more expensive. So let's take a look at the options chain before we get off here and look at some maybe similarly priced stocks and see the difference. Okay, so we're going to start with KO. That's Coca-Cola. And we can see down here, let's see here, that the IV on this stock right now is somewhere, what is this, 18%? So the market doesn't really think that it's going to move too much. And if we look at the open interest, the call volume, we can kind of see that, there's 50,000 calls versus 13,000 puts. Not a ton of contracts here. It's currently trading at $57. So let's go to the $60 strike in, let's say, January for this example. Okay, so we're on the January options chain. Stocks at 57. We're going to look at the $60 strike. And we can see here that, so basically for a $3 move over the next 160 days, the market's pricing this at $1.15. Okay, $1.15 premium for that $60 strike on Coca-Cola. All right, so now I'm going to jump us over to Draftkings, which is kind of similarly priced. Draftkings trading at $53. Okay. IV right now is 51%. Remember, Coca-Cola was like 18, 17%. So, contracts right now in place, we got 167 or 163,000 calls versus 35,000 puts, and basically a lot more interest in this, right? So the market thinks that this stock is going to move a lot more. And really, I mean, DraftKings is at 53. So if we go look at the $60 strike, that's a $7 move, whereas Coca-Cola only needed to move $3. So common sense would say DraftKings would be cheaper, right? Because it's got further to run. It's got to move $7, where Coca-Cola only had to move $3, and everything else is the same. 160 days for that January expiration date. $60 strike. Let's look. $60 strike, $5.20. Remember, Coca-Cola was $1.15. That's almost a 5 times difference, 5 times more expensive. Why? Because of the IV, because the implied volatility, the market thinks that this stock is more likely to move. It's 51% IV. So that's why it's being priced so much more expensive. So let's do one last example. Okay, I'm going to pull up AMC. I'm sure everybody's heard about AMC recently. A lot of real popular stock, ton of options contracts. What do we got? 415,000 calls, 275,000 puts. Total is 691,000. So I mean, there's a ton of open interest in this. IV right now is 155%. So, we were at what, like somewhere in the 50% range for DraftKings. The 18% range for Coca-Cola. And now we're looking at AMC, 155% IV. Now, this stock's only trading for $33. Okay. So if we go look at the January chain, $60 strike, this stock needs to move $27 to get there in the next 160 days. That's almost a 100% move. Let's see the pricing. Come down here, $60 strike. We're in January, $5.85. Okay, so that's the most expensive contract out of the 3. Why? Implied volatility. Okay, so that IV is super expensive. Super important when we're looking at buying options contracts or even selling them. You want to realize that high IV, how that it's gonna make these contracts more expensive. Now, I'm not saying any of these stocks or options or any of these is better or worse than the others. I'm just simply trying to illustrate what IV is and how it greatly affects the price of your contract's time value. Okay, so one more thing I want to note. IV can be high today and low tomorrow, and vice versa. So if you buy DraftKings calls today and everybody else in the market dumps all their contracts, and all of a sudden the IV drops down to like Coca-Cola's levels, the contract price is going to drop too. The stock price could stay exactly where it's at, but all of a sudden you're where that contract was going for like around $5, it can drop down to $1, and you just lost 80% in value, all based off IV. So And the opposite could happen too. You could buy Coca-Cola to tomorrow at $1.15, and if a ton of people come in and start, hammering down with options contracts, now the IV is going to increase. Stock price stays the same, and it might be worth 5 times more. As a rule of thumb for me, when IV is high, I buy shares. When IV is low, I buy calls. You want to be buying on low IV and profiting off the increase in the IV along with the movement in the stock, but that's a whole different video. And really what's considered high IV really depends on each stock, right? Like a lot of the meme stocks right now, like an AMC, IV's trading high on all of them. In some stocks, IV typically can always be running around 80%. Some stocks, IV's always running around 30%. So it's really hard to see. And that's another reason why maybe historical volatility can give you an indication of the type of fluctuation that you'll see in a stock. Anyways, in the next video, I'm going to talk about how you can use IV, implied volatility, to predict where the market is saying a stock price will go and determining the probability of it happening. As always, if you have an idea for a future video, leave it down below in the comments, and please hit the like and subscribe button to support this channel. Come check me out every morning. The market's open. I'm live streaming Talking Stocks with Coach B. Usually start about a half hour before the market opens, but lately we've been kicking it off a little earlier. So if you turn on your notifications for this channel, you'll get alerted as soon as I go live, and then you won't miss out. Thank you. Have a wonderful day.